This is an emergency broadcast. I need you to stop what you're doing, put down your phone, and listen to me very carefully. The rules of the game just changed while you were having dinner. It is Sunday evening, January 25th, 2026. And while the mainstream media is busy talking about football games and celebrity gossip, the fuse has been lit on a financial bomb that is sitting right in the center of Washington, D.C. We are no longer looking at a correction. We are no longer looking at a dip. We are looking at a countdown clock that is flashing red. We are exactly 6 days away from a total system paralysis. Ladies and gentlemen, Asian guy here. This afternoon at 2:14 p.m. Eastern Standard Time, President Trump sent a tweet that has effectively frozen every risk manager on Wall Street. It was not a negotiation tactic. It was not a subtle hint. It was a declaration of war on the budget process. The message was short, brutal, and terrifyingly clear. Government shutdown in 6 days. The swamp is broke. No deal until America is first. Now, I know exactly what you're thinking. You're sitting there thinking, Asian guy, come on. We have seen this movie before. We saw it in 2018. We saw it in 2023. It is political theater. They scream, they shout, they shut down the national parks for a weekend, and then they print the money and everyone goes back to work. It is just noise. If that is what you are thinking, you are making the most dangerous mistake of your financial life because this is not 2018. In 2018, inflation was 2%. The debt was 20 trillion. The world was at peace. This is 2026. Inflation is running hot. The debt is 40 trillion. The geopolitical order is collapsing. And most importantly, the consequence of this shutdown is fundamentally different from anything we have ever faced. This is not just about locking the doors to the Smithsonian Museum. This is about blinding the pilot of the airplane in the middle of a hurricane. We are facing a data blackout. You have to understand how the modern financial system actually works. It is not run by humans sitting in a room making gut decisions. It is run by algorithms. It is run by massive supercomputers at BlackRock CK, at Vanguard, and at the Federal Reserve. These machines consume data like oxygen. They need the Consumer Price Index (CPI) to measure inflation. They need the non-farm payrolls to measure employment. They need the PCE deflator to measure consumer spending. These numbers are the radar that the pilots use to fly the global economy. Every interest rate decision, every bond yield, every stock trade is calculated based on the expectation of this data. But here's the nightmare scenario. If the government shuts down on Friday night at midnight, the lights go out at the data agencies, the Bureau of Labor Statistics, BLSAT, the people who tell us if inflation is killing us, closes its doors. The Bureau of Economic Analysis, BEA, the people who tell us if we are in a recession, sends its workers home. The website goes dark. The reports are canceled. There will be no inflation report next week. There will be no jobs numbers. The radar screen goes completely black. Now imagine you are Jerome Powell. Imagine you are the chairman of the Federal Reserve. You are already losing control of the bond market. Yields are spiking. The banks are wobbling. And suddenly, you're told that you have to fly the plane for the next 3 weeks with zero instruments. You don't know if inflation is rising or falling. You don't know if unemployment is spiking. You're flying blind in the fog. What do? Do you sit tight and do nothing? That is dangerous. Do you raise interest rates and risk crashing the economy when you can't see the dashboard? That is suicide. No. When a central bank flies blind, they default to their most primal bureaucratic instinct, panic. And the only tool they have to soothe their panic, the only button on the dashboard that works when their radar is dead, is the printer. The market knows this. The hedge funds know this. The sovereign wealth funds in Dubai and Singapore know this. They know that a data blackout forces the Fed into a defensive posture. It forces them to flood the system with liquidity just in case. They cannot risk a deflationary liquidity freeze when they don't have the data to track it. So they will print. They will inject reserves. They will launch a safety print to keep the gears oiled while the government is closed. They will choose inflation over instability every single time. This is why you are seeing gold hitting a new all-time high tonight. This is why you are seeing silver smashing through $100 and refusing to look back. The market is not waiting for the shutdown to actually happen. The market is front-running the inevitable response. The smart money is buying the anti-dollar now because they know that by next week, the dollar is going to be diluted by a panicked Federal Reserve trying to navigate a political crisis. They are buying the insurance before the house catches fire. They are dumping the currency that depends on politicians and buying the money that depends on physics. And the timing could not be worse. We are not entering this shutdown in a period of calm. We are entering it in a period of extreme fragility. The repo market, the plumbing of the financial system, is already showing signs of stress. The reverse repo facility is empty. The cash cushion is gone. A shutdown now is like kicking the crutches out from under a man with a broken leg. It guarantees a fall. And to make matters worse, this political deadlock is not just about budgets and deficits. It has become personal. It has become violent. While Washington argues about numbers, something terrible has happened in the streets of the Midwest. Something that has turned this financial dispute into a social war. We need to talk about the spark. We need to talk about the reason why the Democrats in the Senate are vowing to burn the funding bill to the ground rather than compromise. This is where the story stops being about numbers on a spreadsheet and starts being about fire in the streets. We have talked about the data blackout. We have talked about the Federal Reserve flying blind, but you cannot understand why this government shutdown is inevitable. You cannot understand why the politicians are refusing to sign the deal until you look at what is happening on the ground in the American Midwest. While the algorithms are watching the bond yields, the rest of the country is watching a tragedy unfold in real time. We need to talk about Minneapolis. For the last 48 hours, reports have been flooding into our news desk regarding a massive escalation of force involving federal agents. We are not talking about local police. We are talking about federal assets, ICE, Border Patrol, and federal marshals being deployed to domestic operations. And late last night, the situation went from tense to catastrophic. We have confirmed reports of a second shooting involving these federal agents in less than 3 days. But this time, the narrative is different. This time, the victim was not a suspect. The victim was not armed. The victim has been identified as a 34-year-old ICU nurse, a woman who spent the last few years saving lives in a local hospital, a woman who was simply walking home from a 12-hour shift when she crossed paths with a federal patrol. The details are still coming in, but the reaction is already explosive. Videos of the incident are circulating on social media, uncensored and viral. The public outrage is not just anger, it is a visceral collective scream. People are seeing a healthcare care hero, someone who represents the very best of the community, gunned down by the very government that is claiming to protect them. This has triggered a wave of protests that is spreading faster than the news itself. Minneapolis is burning. The streets are filled with thousands of people. The National Guard is being mobilized. We are seeing the early stages of a social supernova, and this is the spark that destroys the budget deal. You have to understand the political calculus in Washington. Yesterday, there was a slim chance that the Democrats and Republicans might cut a deal to keep the government open for another month. Today, that chance is 0. The Senate Democrats have already come out and drawn a line in the sand. They are vowing to block any funding bill that includes money for these federal deployments. They are saying, "We will not sign a check that pays for the bullets used to shoot nurses." The political cost of compromise has become too high. If a Democrat votes for this bill now, their career is over. If a Republican votes to defund the agents, their base will revolt. It is a deadlock. It is a stalemate written in blood. So the shutdown is no longer a risk. It is a certainty. The government will close on Friday because the two sides are no longer arguing about money. They're arguing about morality. They're arguing about justice. And when politics becomes emotional, logic leaves the room. This guarantees the data blackout. It guarantees the Federal Reserve will be left alone in the dark. But look at what this does to the psychology of the market. Markets hate uncertainty, but they fear chaos. When you combine a financial collapse, the liquidity freeze with social unrest, Minneapolis, you get the perfect storm for a precious metals. Investors look at the screen and see the banks failing. They look out the window and see the cities burning. Where do they put their money? Do they buy stocks and companies whose stores are being looted? No. Do they buy bonds from a government that is shooting its own citizens? No. They buy the only thing that is neutral. They buy the only thing that is private. They buy gold. They buy silver. This is why the premiums on physical metal are exploding right now. People are not buying silver to make a profit. They are buying it to buy safety. They're buying it because they realize that the system is breaking down on every level, financial, political, and social. The trust is gone. And when trust vanishes, money velocity spikes. People run away from the currency and into the asset. This brings us to the most alarming signal on the technical charts. We are seeing a collapse in the time to travel. The price of silver is not just going up, it is speeding up. It is moving faster than it has ever moved before. We need to analyze the velocity signal. We need to show you the math that suggests $110 is just days away. If the social chaos in Minneapolis is the fire, then the price action we are seeing on the charts is the explosion. I need you to stop looking at the price level and start looking at the speed. Because in financial markets, velocity is everything. Velocity tells you the strength of the move. Velocity tells you if it is a trade or a panic. And right now, the velocity of silver is telling us that the dam has completely burst. We are tracking a metric called time to travel. This measures how many days it takes for silver to move $10 in price. And the data is absolutely terrifying for the short sellers. The time intervals are collapsing. The train is accelerating. Let's look at the history of this rally. When silver moved from $20 to $30, it was a slog. It was a war. It took 145 days. The banks fought every inch. The algorithms shorted every rally. It was a grind. Then when we moved from $40 to $50, things started to speed up. That move took 39 days. The resistance was weakening. The shorts were getting tired. But look at what just happened. Look at the move from $70 to $80. It took 6 days. And the move from $90 to $100, which should have been the hardest psychological barrier in history, it took just 10 days. Do you see the pattern? 145 days, 39 days, 6 days, 10 days. This is an exponential decay in resistance. It means the sellers are gone. It means the algorithmic suppression, the computer programs designed to cap the price, has broken. The machine that usually says sell at resistance levels has been overrun by a tsunami of physical buying. We are now in the vertical phase. This is the part of the chart where physics takes over. It is like a rocket leaving the atmosphere. The higher it goes, the less resistance there is, and the faster it climbs. Based on this velocity, based on the pure momentum of the last 2 weeks, my analysis is screaming a warning. We are not stopping at $100. If the government shutdown hits on Friday and the data blackout panic sets in, we are going to slice through the next levels like a hot knife through butter. The resistance between 100 and 110 is non-existent. Why? Because nobody has ever sold there before. There is no memory of price at these levels. It is blue sky. I'm predicting that we could see 110s by next weekend. That is a $10 move in 5 days. It is entirely consistent with the velocity trend we are seeing. And here's the kicker. Usually when an asset goes vertical, you expect a pullback. You expect a correction. But silver is unique. Silver is a Giffen good in a crisis. A Giffen good is a strange economic phenomenon where demand actually increases as the price goes up. Why? Because people see the price rising and they think, oh my God, the currency is dying. The higher the price goes, the more panic it creates and the more people buy. It is a feedback loop. At $100, people are more desperate to buy silver than they were at $20. At $20, it was an investment. At $100, it is survival. The psychology has shifted from greed to fear, and fear is a much, much stronger motivator. So do not look at the chart and think it is overbought. Overbought is a term for normal markets. In a currency collapse, nothing is ever overbought until the currency is dead. We are watching the death of the resistance. But while the price of silver is exploding, there's a dark cloud forming under the surface of the banking system. There is a technical signal, a warning light on the dashboard of the plumbing that suggests the stock market is about to have a heart attack. While silver flies, liquidity is freezing. And we need to talk about the liquidity death spread. We need to explain the spread between SOFR and IOB to us and why it is about to crash your 401k. This is the part of the broadcast where the casual viewers tune out and the serious investors make their fortunes. I need you to put down the price chart for a moment and come with me into the engine room of the financial system. Because while everyone is staring at the shiny paint on the car, the stock prices, and the silver candles, the oil pressure in the engine is dropping to zero. We are witnessing a technical signal that has predicted every major market crash of the last decade. It is a signal that is flashing red for the first time since March 2020. We call it the liquidity death spread. You need to understand two acronyms that run the world. The first is SOFR, the Secured Overnight Financing Rate. This is the cost of real money. It is what banks and hedge funds charge each other to borrow cash overnight using U.S. Treasuries as collateral. It is the heartbeat of the private market. The second is IRB, the interest on reserve balances. This is the fake money rate. It is the bribe that the Federal Reserve pays the commercial banks to keep their cash sitting idle at the Fed. In a healthy, functioning world, these two numbers hold hands. They move together. If the Fed pays 5%, the private market charges 5%. The spread should be zero. But right now, the spread is blowing out. We are seeing SOFR, the private rate spike, significantly higher than the IORB. Do you understand what that means? It means that private banks are saying, I don't care what the Fed says. I don't care about the official rate. I'm terrified to lend you money. It means that cash is becoming scarce in the real economy, even while the Fed claims there is plenty of it. The banks are hoarding liquidity. They are refusing to lend to the repo market. They are looking at the looming government shutdown. They are looking at the chaos in Minneapolis. And they are saying the collateral is bad. Well, this is the nightmare scenario. The entire stock market, the S&P 500, the NASDAQ, the AI bubble is built on leverage. It is built on cheap overnight borrowing. When SOFR spikes, that leverage becomes expensive. When the spread widens, it is like sucking the oxygen out of the room. The hedge funds get a tap on the shoulder. It is the margin clerk. He says the cost of borrowing just doubled. You need to sell your stocks to raise cash. This is what causes a liquidity event. Stocks don't crash because companies are bad. They crash because the traders run out of cash to hold their positions. We saw this in 2008. We saw it in 2020. And we are seeing the exact same setup right now, just 6 days before the government turns off the lights. But here's where it gets interesting for you. The stacker in a liquidity freeze. Almost every asset gets sold. Stocks get sold, bonds get sold, Bitcoin gets sold. Everything that has counterparty risk, everything that depends on another human being fulfilling a promise gets dumped for cash. But there is one asset class that acts as the final collateral. There's one asset that has zero counterparty risk. Physical gold and silver. When the banks stop trusting each other, when JP Morgan won't lend to Citibank because they don't trust the treasury collateral, they will still accept gold. They will still accept silver because metal doesn't need a credit rating. Metal doesn't need a government to stay open. Metal just is. This is why we are seeing this divergence. Usually in a crash, everything goes down together at first. But this time, silver is rising while the liquidity dries up. This tells us that the market has already identified the winner. The market knows that when the data blackout hits and the liquidity freeze strikes on Friday, the only safe place to hide is outside the banking system. The liquidity death spread is not a warning for silver. It is rocket fuel for silver. It is the signal that the paper system is seizing up and the physical system is taking over. So watch this spread tomorrow morning. Watch the repo rates. If you see S-offer tick up by 5 or 10 basis points while the Fed does nothing, you know the freeze has begun. You know the heart attack is happening. And this brings us to tomorrow. Monday morning is going to be a bloodbath for the unprepared and a bonanza for the strategic. We have the Trump tweet. We have the Minneapolis riots. We have the liquidity warning. The algorithm is going to react violently at the open. I have run the simulations and I have a very specific set of predictions for what you're going to see when the bell rings on Monday, January 26th. This brings us to the most immediate and actionable part of this broadcast. We have looked at the macro picture. We have looked at the plumbing, but you need to know what is going to happen when you wake up tomorrow morning. You need to know how to navigate the first trading session of the most dangerous week in financial history. Based on the convergence of the Trump tweet, the Minneapolis riots, and the liquidity freeze, the algorithms are primed for violence. Here is my forecast for Monday, January 26th. First, look to the east. Before New York even pours its first cup of coffee, the Asian markets are going to set the tone. And I'm predicting a massive gap up in the price of silver at the Asian Open. You have to understand that the markets have been closed for 48 hours while the world has been burning. Orders have been piling up in the system all weekend. Hedge funds in Singapore, family offices in Hong Kong, and traders in Sydney have been reading the headlines. They see the shutdown, they see the shooting, and they are panic buying at the market open price. This creates a gap. The price will likely not open at $100. It will likely open at 102s or 13s. It will jump. If you're waiting to buy at Friday's close, you're going to be disappointed that price is gone. The train has left the station. Second, watch the VIX. The volatility index, the fear gauge of Wall Street, has been suspiciously quiet lately. It has been manipulated and suppressed. But tomorrow, the 6-day countdown to the shutdown officially begins. The reality of the data blackout is going to hit the risk managers on Wall Street like a cold bucket of water. I expect the VIX to explode higher. When the VIX spikes, algorithms automatically sell stocks. It is a mechanical reaction. So expect the S&P 500 and the NASDAQ to open deep in the red.